If you're looking to invest in your own backyard, you've probably come across VCN before. It's Vanguard's total market solution for the Canadian stock market. While many people just stick to the 60 biggest companies in Canada, VCN actually digs a little bit deeper, giving you a slice of everything from the massive banks and oil giants to the smaller up-and-coming players that most investors miss. But is more always better? A market like Canada, where a handful of banks and energy companies do most of the heavy lifting, does owning a small cap stuff actually move the needle? Today, we're looking at what's actually inside the fund, comparing VCN to XIC, and seeing why this might be the most complete way to own the Canadian economy in a single ticker. Without further ado, let's get right into it. So, what is VCN? Officially, it's the Vanguard FTSE Canada All-Cap Index ETF. In plain English, it's a one-ticket solution to the entire Canadian stock market. Unlike a regular index that might only look at the blue-chip giants, VCN actually tracks the FTSE Canada All-Cap Index, which includes large, mid, and small-cap stocks. The fund is built for the investor who wants to capture the full return of the Canadian market. When you buy one share, you're becoming a very small part owner over roughly 180 to 200 different companies. Because it's a Vanguard fund, it's famous for being incredibly cheap. The MER is sitting at just 0.05%, meaning you pay about $5 a year for every $10,000 you have invested. It's one of the most cost-effective ways to get broad exposure without having to manage a bunch of individual stocks. When you're looking for a Canadian core holding, the big battle is usually VCN versus XIC. And look, XIC tracks a slightly different index. It's tracking the S&P TSX Cap Composite and usually holds around 240 companies. The part is VCN versus VCE, which VCE only holds the 50 largest companies in Canada. If you just want the banks and the big oil names, VCE works great. But most people choose VCN because the extra exposure to mid and small sized companies gives you a better chance of catching the high growth hidden gem before it actually becomes a household name. We can't talk about the Canadian fund without talking about the risks. The first is sector concentration. Like almost every Canadian index, VCN is very heavily weighed on financials and energy, which usually makes up about half of the entire fund. If the Canadian housing market or global oil prices take a hit, VCN is going to feel it, absolutely feel it. The second risk is home bias. While it feels safe to invest in your own country where you live, owning VCN means you have zero exposure to the massive tech growth in the US or the industrial power of Europe and Asia. Most investors use VCN as a Canadian slice of their portfolio, usually around about 20 to 30%, rather than making it their only investment. It's an absolutely great tool, but it works best as a part of global portfolio. When you look at the companies inside, you'll see the same names you see on every street corner: RBC, TD, Shopify, and Enbridge. These massive companies dominate the fund because it's market cap weight. The more a company is worth, the more of it you own. And this gives you a lot more stability, since these blue-chip companies have a long history of making money. However, the all-cap part of the name means you also own smaller companies in sectors like mining, technology, and real estate that the bigger indices ignore. While the smaller companies are more volatile, sure, they provide a level of diversification that helps capture the growth of the entire Canadian economy, not just the massive corporations at the top of TSX. For many Canadian investors, the main event is the dividend. Canada is known for its high-yielding stocks, and VCN captures that perfectly. It pays out a dividend every 3 months, typically in early January, April, July, and October. The yield generally hovers between 2.5 and 3%. While that's not as high as owning a specific high-dividend fund like XCI, it's a very healthy, growing payout. If you're in the building phase, setting up a DRIP is a smart move. It allows those quarterly checks to automatically buy more shares of the fund, which helps your investment grow much faster over the long run, without you having to log in and make all these trades manually. So, should you add this fund to your portfolio? It's definitely a buy candidate for anyone who wants a simple, low-cost way to own the Canadian market. So I would say choose VCN if you want the broadest possible exposure to Canada, including smaller companies, and you want the rock-bottom fees the Vanguard is known for. Then I would say choose XIC if you prefer the iShares ecosystem, first of all, and you want a slightly larger list of holdings, around 240 stocks. And choose VCE if you only care about the 50 biggest blue chip companies and don't want that extra volatility of smaller stocks. Just a quick heads up before we wrap up, this video is for educational purposes only. I'm not a financial advisor, just a guy sharing my research and my opinions, so definitely do your own homework before you move your money around. But thank you once again. If you found this breakdown helpful, hit the like button and subscribe to the channel. It actually helps the algorithm realize that people are getting more value out of these videos. Thank you for hanging out and watching the video once again, and I'll see you in the next one. Take care.